Yes, good afternoon to all of you. Good afternoon, friends. Yes, good afternoon to all of you. So yesterday's class was curtailed by a power failure at our place. Uh, One moment. Sorry for a small disturbance. Say we understand that in cash flow statement, there are two methods that you have. One is direct method, the other one being indirect method. And we shall take up on to the first problem where we need to try under both direct as well as indirect method. Is that okay? So now let us just take up on to question number 1. Find out the cash from operations by direct method and indirect method from the following information. Operating statement of ABC company for the year ended 31st of March 2017. Sales 5 lakhs, less cost of goods sold 350,000. administration and selling overheads 55,000, depreciation 7,000, interest payment 3,000, loss on sale of assets 2,000, profit before taxation 83,000, tax 30,000, profit after taxation 53,000. Then you have shareholders fund 60,000 and 50,000, non-current liabilities 25,000 and 30,000, creditors 12,000 and 8,000, creditors for expenses 10,000 and 7,000, and we have provisions 8,000 and 5,000. Total comes to 115,000 and 100,000. Assets, fixed assets 75,000 and 65, investments 12,000 and 10,000. Current assets, inventories 12 and 13, debtors 10,000 and 7,000, cash 6,000 and 5,000. Total is that. So with this information, we are expected to do under direct method as well as indirect method. So this is an institute study material problem. Now let us just take up for the purpose of discussion. Firstly, direct method. So for direct method, we need to know how much is a collection from customers. So to know about that, we need to have our debtors account opening and this being closing. So with the sales information of 5 lakhs, we can find out our debtors account. Opening balance 7,000 to sales 5 lakhs and a closing balance 10. 507, 507, 497 by cash. Okay. So we shall try in this fashion. Cash flow from operation, cash flow from investing, cash flow from operating. Then we shall find out the increase or decrease in cash. In fact, it is an increase. Increase in cash and cash equivalent 1,000. Opening cash and cash equivalent 5,000. Closing cash and cash equivalent will be 6,000. So under that, direct method, collection from customers 4,97,000. So next one is cost of goods sold. From cost of goods sold, we will be finding out cost of goods sold, purchases. So cost of goods sold is equal to opening stock plus purchases minus closing. So we know opening 13, closing 12. 350 equal to opening 13 plus purchases minus 12. So we are expected to take up 350 plus 12 minus 13 equal to purchases. So that is going to be 349. With the creditors figure that you take up, by balance brought down 8 and to balance carried down 12, and by purchases 349, 357 and 345 to cash. So not only this item we are expected to take up, even administration, all these are expected to be taken up. So for that, we do have creditors for expenses and provisions, both to be taken up. So we can take up creditors for expenses and provisions. So with opening balance for creditors for expenses, so 5,000 and 7,000 together, 12,000, and the closing balance being 10,000 and 8,000, 18,000. And by, if there were to be any prepayment also, we need to take into consideration 55,000. So by profit and loss account for expenses, admin expenses, 55,000. And this will be 67,000. Then 51,000 is the amount paid, cash 51. So here 345 plus 51, which is equal to 396. 396. Payment to suppliers and expenses. So how much is that we have taken up? We have taken up part 396. Then administration, we have taken up one by one. Depreciation is a non-cash item. Interest payment will come under financing. Interest paid 3,000. Loss on sale of assets. Sale of assets, we will update that for sale of assets. They mentioned 2,000. So as far as fixed asset is concerned, so you do not know accumulated depreciation and all that. You have 65,000 opening, closing balance 75,000. And we have a depreciation to the extent of 7,000. Now let us prepare fixed asset account. To balance brought down 65, the closing balance 75 by depreciation. By depreciation to the extent of 7,000 to gain. Sorry, in fact, it is loss. By loss to the extent of 2,000. There is no piece of information that they are giving. It was sold for any amount of price. So net of that, we can take it up. So 77.84. So nowhere they have informed anything about how much was the sale value. So 919 to cash. So purchases to the extent of 19. So purchase of fixed asset 19,000 outflow net. Maybe some exchange of old item, new item. It could be like that. That sort of explanation only we can offer. So depreciation also we have taken up, interest also we have taken up, loss also we have taken up. Tax paid to the extent of 30,000 we are going to take up. Tax paid. 71,000 cash flow from operations. So that's all as far as from profit and loss account is concerned. Shareholders funds to the extent of 10,000 increase their equity share capital issue. 10,000. Non-current liabilities. So that means there were some repayment of loan to the extent of 5,000. Repayment of non-current liability to the extent of 5,000 involving outflow. So This is over. This is also over. Creditors for goods and for expenses we have taken up. Provision also we have taken up. Investments there to the extent of 2000 went up. So purchase of investments. 2000 fixed assets we have taken up. Inventories we have taken up. Debtors we have taken up. Cash and bank balance we have already taken up there. So this being 21,000. This being 2000. $497 minus 396. 497 minus 396 minus 30 minus 21. Plus 2, 52. So let me just check up if there were to be anything else that we have missed out. $497, correct. Then purchases, 349. Well, then creditors account, 7 and 5, 12. Administration expenses, 55 we have taken up. See, one important thing that we understand is that profit after taxation you have. So by looking into shareholders funds, I took it up as raising of that, but we are expected to do it in a different way. That is a area where we need to concentrate. So opening equity funds, 53,000. Add profit after taxation, 50. Profit after taxation is 53,000. 103,000. Closing equity funds, 60,000. So which results in 43,000 rupees reduction. So in fact, I took it up by mistake. Issue of equity capital. Actually, dividend paid. Dividend paid to the extent of 43,000. 43,000, which results in an outflow. So 46, and it is, let me just take up 46, 51. So 3,000 plus 43,000 plus 5,000, 51,000 plus 21,000, 72,000. Cash and cash equivalent, let me just check up. So it had just gone up. Now let me just check up. There may be a totaling error. Let me just check up. So we took up, there is a totaling error. So 67 minus 18, that comes to 49,000. This being 49,000. So 49,000 49 plus 345, that comes to 394. 394, 103, 73. So here it is 73,000 minus 21,000 minus 51,000. This results in 1,000. So this is the way on direct method we have just made. I have committed some error. That is totaling error, and we have not taken profit after taxation. See now, cash from operations under indirect method. So under indirect method, how the same has got to be handled. So just watch out. We will take up profit after taxation figure. Profit after taxation figure of 53,000. To that, we will add back depreciation. Depreciation, we will add it back to the extent of 7,000. Then interest payment to the extent of 3,000, we are going to add back. Then tax provided, 30,000. Then tax paid, 30,000. And loss on sale of asset should be taken up to the extent of 2,000. Now let us just try all that. 53,000 plus 10,000 plus 2,000. So brought forward 65,000. Then we will take up those changes in working capital. Changes in working capital item other than cash. Creditors change 4,000. Change in creditors 4,000. There is changes in creditors for expenses 3,000. Then provision 3,000. Then inventories 1,000. Debtors 3,000. It is 65,000 plus 4,000 plus 7,000 minus 3,000. So you get 73,000. Same figure like here. So in one problem, we have finished off 2 items. Is that okay? So we have solved cash flow. Yesterday we were discussing about as how to treat factoring with recourse and without recourse. And we have discussed something about cash and cash equivalent. And we have done one problem for direct method and indirect method. Please just try the problems that we have in our institute study material. So with that, Ind AS 7 is getting over. Now we will take up on to Ind AS 1, the first accounting standard that we have. One moment, I'll just come. Presentation of financial statement. Ind AS 1 presentation of financial statement. So here we will be discussing about general purpose financial statement into 5 different components: balance sheet, statement of financial position, income statement, profit and loss account, statement of cash flow, statement of changes in equity, and lastly, notes and disclosures. So these are the 5 components that you have for general purpose financial statement. Then assets and liabilities are classified based on operating cycle, current and non-current. Current items in which we will take it up as hardcore, non-core. So similarly here, hardcore, non-core. So what is it we have for hardcore? So though they have not used the term as hardcore, it is my way of looking into things. In hardcore, we will be having for inventory, receivables, and in this particular case, accounts payable, accounts receivable, accounts payable. So what could be non-core item? Non-core item could be other than inventory, accounts receivable, cash and bank. Same way, other than accounts payable and all that. Even in the case of hardcore, we will classify them into 2 categories: financial, non-financial. Here it is financial, non-financial. On what basis we classify item as current and non-current? So assets and liabilities for hardcore items, it is all done by operating cycle, based on operating cycle. For non-core item, less than or equal to 12 months. Less than or equal to 12 months. Okay. In fact, I would just say equal to 12 months, not less than or equal to, equal to. Financial items where you have debtors and bills receivable. Non-financial hardcore current assets would be inventories and prepaid. Here it is creditors and bills payable. Non-financial item could be your warranty provisions and all that. Warranty provisions and all that. So non-core item as any current assets will come here. Here I would just see non-current, especially onto one moment. I just need to make a change in the presentation. So here, this is assets and liabilities. Assets and liabilities. So I will put this way. Current assets and liabilities. Current assets and liabilities, So this portion is less than or equal to is correct only. Within 12 months of non-current liability items. So this portion not affected by, this portion is not affected by operating cycle. So I will put it this way, these hardcore items are affected by operating cycle. This non-core item not affected by operating cycle, we are all less than or equal to 12 months will come into operation. So assets are to be classified into current, non-current. So under that category, you have PPE, intangibles, and investments. Current item under that, financial and non-financial. Then liabilities are to be taken up as current and non-current. So financial, non-financial, including provisions. Non-current liability in there is here it will be including current portion of long-term borrowing. Here it is bond, deferred taxation, deferred tax liability, etc. These items will come there. Now, we are expected to try one problem, basically to make a good presentation of a balance sheet with previous year's figures, with details shifted to the schedule. I would like to try this with the help of Excel. Now we will do that. So we will trying out problems. India is 1. Now let us just take up question number 1. Question number 1, A Limited has prepared the following draft balance sheet as on 31st of March X1. Cash 250 and 170, cash equivalent 70 and 30, non-controlling interest shares of profit for the year 160 and 150, dividend declared and paid by A Limited 90 and 70, accounts receivable 2,300 and 1,800, and inventory at cost 1,500 and 1,650. Inventory at fair value less cost to sell and complete. There is inventory at fair value less cost to sell and complete 180 and 130. Investment property 3,100. Then property, plant and equipment at cost 5,200 and 4,700, 12,850 and 11,800. Long-term debt 500 crores due on 1st of January each year. 3,300, 3,885. Interest accrued due less than 12 months 260 and 290. Share capital 1130 and 1050. Retained earnings at the beginning of the period 1875 and 1740. Profit for the year 1200 and 830. Non-controlling interest 830 and 540. Accumulated depreciation on PPE 1610 and 1240. Provision for doubtful debts 265. Trade payables 880 and 790. Accrued expenses 15 and 30. Warranty provision for 12 months from the date of sale 600 and 445. Environmental restoration provision. Restoration expected in 20x6, a long-term provision. Then provision for accrued leave due within 12 months 35 and 25. Dividend payable 150 and 230. And total is 12,850 and 11,800. Prepare a consolidated balance sheet using current and non-current classification in accordance with AS1, assuming operating cycle is 12 months. Right. So now we will try making a very good presentation. So now let us just take up the presentation in a very sincere way. Now, let us just take the calculator and make a very nice presentation. Our calculator is very much here, and we will just take up one by one. The first item that we will be taking up will be the balance sheet on the asset side. Say I am just keeping the keyboard separately when I'm writing. When it is to be done, I got to make some sort of changes to the system. So now let us just take up. So since we understand that the information we're all belonging to non-controlling interest that we have, we will title it out as a consolidated balance sheet for the company EA Limited. Consolidated balance sheet. Consolidated balance sheet of EA Limited as on 31st of March X1. X1. Firstly, we have the habit of doing it as far as ENDAS one is concerned, firstly with assets. We will give the title, we will provide the reference of schedule number, then amount for the 31st of March 20X1 and the other one for the previous period, our comparative balance sheet 31/3/20X0, right? The first and foremost thing that we take up will be first item, we will title it out as asset side. Next item, non-current assets firstly. Non-current assets, we will take up schedule number 1. Then comes non-current assets. Then we will take up current assets. Under that, financial and financial where you have cash and bank balance. So it is better that we will put them under 2. Then non-financial, three. So then we will have equity and liabilities. Under that, what and all we have, let us just take up equity capital. Then you will take up retained earnings. So in this particular case, we will have a separate working note for retained earnings, because it is consolidated retained earnings that we will be taking up. Then we do have something called as non-controlling interest. Non-controlling interest. Then we have liabilities. Under that, non-current liabilities. Then under that, financial, non-financial, current liabilities, financial, non-financial. We will take up this as 5. This is 6, 7. This is 8. Correct? So we will take up from the question, and we will have separate schedule. We will have as on schedule number 1, or you can see notes. Non-current assets, PPE. Now let us just run through. As we take, we will try them. Okay. So we have current assets, financial 2. Schedule number 2, financial. Under that, cash and cash equivalent. So in fact, I will fix this in the next column, and these one column height, because for the we will take up schedule number and all that. We will keep it as small as possible. Okay. See, now we will go according to the order only. 250, 170, 70, 30. I copy this. Let me see as whether yes. Yeah, we got it right. So even typing also we can just avoid. So let me just see as whether they can be total. Yeah. Financial cash and cash equivalent. Then comes non-controlling interest. Where would this non-controlling interest that we will be adjusting? See, the financial profit after taxation, what we have here, profit for the year that we have 1200 and 830. From there, we will be deducting towards the amount attributable to non-controlling interest. So until such time, this item is to be kept pending. So until such time, this item will be kept pending. So we are not taking it up, or we will take this up now. So we will have a particular place, schedule number 4. Schedule number 3, non-financial. We will take up schedule number 3, non-financial current assets. Financial current assets. Schedule number 4. Schedule number 4. Under that, retained earnings. We have retained earnings given in the problem. Retained earnings 1875 opening current year earnings. Now let us affect the total. And less non-controlling interest. Non-controlling interest we have in the other side. So these two numbers, we will fix it up here. Okay. So we will make those changes whenever they are coming up. So therefore, don't copy, just watch out. Or else we may have to deduct towards dividend and all that. So I will not be taking up that. Okay. So I will just keep it pending. Because you have dividend declared and paid by A Limited. Towards the end, dividend payable also you do have 150, 230. So we will take up that. So this 90 and 70 we will be deducting. Less dividend paid. Instead of adjusting in retained earnings, it got adjusted here. So 2825 and 2350. Now we can take it up. So we have taken up cash and cash equivalents we have done. Non-controlling interest and dividend payment we have taken up. Now accounts receivable we are expected to take it up. So that will come under schedule number 2. Under that we will have accounts receivable. How much is the figure for accounts receivable we are going to take up? 2300 we are going to take up. But we have provision for doubtful debts to the extent of 200. So we are expected to deduct the corresponding provision. So equal to 2300 minus the provision that we have on the other side, 200. Next one, where we have 1865. 1800 minus 65. We have accounts receivable that way. So inventory at cost will not come under financial item. So there is a need for me to explain what is financial and non-financial. I will do that when we take a financial instrument. At this moment, you can take it up as under financial. So this item inventory at cost at fair value less cost to sell, we will keep it under non-financial. Inventory at cost. The next one, inventory at fair value less cost to sell. Right. So then we have investment in property and PPE. So before that, let me just total up. So financial item 2420 and 1935. 1935. Non-financial items we can take it up as 1680 and this number. Correct. Almost we have completed accounts receivable, inventory at cost, inventory at fair, there is fair value less cost to sell. Investment in property, normally when we have any depreciation, they will be providing. So here we understand accumulated depreciation only for PPE they have just given. And now let us just take up on to that. Where it is non-current asset, PPE, we can take it up as 5,200 minus 1,610. 5,200 minus 1,620. 52. It is 3,590 and 4,700 minus 1,240. 3,460. Then investment in property. Investment in property, they have provided 3,100. The sum of these two is this. Sum of these two is this. Huh? சோழிங்கநல்லூர் போகணும் மண்டே. ஸோ இந்த சிஸ்டம் ஆன் பண்ணிவிடுங்க. சிஸ்டம் ஆன் பண்ணி இந்த கிளாஸ் வரைக்கும் வச்சுட்டு போயிடுங்க. 6690 and 6560. See, there is nothing that we have for recording. So now let us just take up. It is 10,790 and 10,275 that you have. And we have 3 more schedules to go. So now let us just keep up this. இது அந்த இது டிஜிட்டல் ஏன் இப்போ டிஜிட்டல் பண்ணிடலாமே இதை கைது போகிறது. ம் இது எவ்வளோ பக்கம் இருக்கு? See, now let us just take up equity, share capital, all that we will pick it up from here. So now asset side over, now liability side. We have long term to the extent of 500 crores due on 1st of January each year, which they given as 3,300 and 3,885. And only 500 is due every year. So that means a portion of which is 500 to the extent we are expected to take up as part of current, and the remaining amount is what we are expected to take up. So now let us just take up that schedule, those schedules. So though a simple job only, but we need to keep everything in our mind and coordinate. Now schedule number 5. Schedule number 5. financial non-current liability. Financial non-current liability அது அப்படி இருக்கு. Where we have long-term debt. Long-term debt. So we have 3,300 less current 500. So totally it is this portion. Same way for previous year. 3,885 minus 500 is going to be 3,885 minus 500. 3,385. So before we could forget, let us just take up this portion under current liabilities. Under current liabilities, this will come under financial current liabilities only. So schedule number 6, non-financial non-current liabilities. Schedule number 7. Current liabilities, financial. Schedule number 8. Current liabilities, non-financial. We will take up one by one. So this one, schedule number 5, we will take it up. Equal to we will take up one by one. So this 500 what we have deducted have got to be shown under financial item only. Financial. So I am taking up creditors and expenses here. Here I will be taking up current portion of non-current liability. How much is that? 500 each. So one item we have taken up in 2 different places. That's all. Interest accrued on long-term debt 260 and 290. Interest accrued. Interest accrued. Yeah, here. 260, 290. So we have just done all items on the asset side, liability side, long-term debt, and share capital, on which there is no change that you have. There is nothing we can show separately. You will take up so share capital, retained earnings and profit we have taken up. Non-controlling interest has got to be reported separately. Accumulated depreciation we have taken up. Provision for bad and doubtful debts we have taken up. Then this is hardcore payable 880. Paid payable. Trade payable 880 and 790. And accrued expenses that we have, that also we will take it up. Warranty provisions will not come under financial, that will come under non-financial only. Environmental restoration, that will come under non-current liability under non-financial. Provision long term. Provision for accrued leave 35 and 25. This will also come alongside of non-financial only, 35 and 25. Accrued leave. Provision for accrued leave. Then dividend payable, which is to be paid in the form of cash, will come under financial only. One moment. So now let us just take up on to dividend payable. Now let us affect the total. So non-financial, financial we have taken up. Non-financial current liabilities, financial non-financial we will just update. So automatically the total of assets and the total of liabilities matching. So with that, we have just taken up a basic lesson on Ind AS 1 also over. So remember where we were noting down the AS that we have completed. So we were having 105 we have done. So we have just done 1-7. I think this was not the one that we were doing it. Anyway, in some place I've just made note. So yesterday up to it was 17. Today is 7 and 1 over. So 19 we have just completed so far. That is what I can tell for sure. So now we will take up now on to in Ind AS 113 we will take up fair value. That is fair value measurement. Ind AS 113 fair value measurement. What is that we have in fair value measurement? See, for a moment, I will stop and then I will share the screen. So I'm not just having that particular PPT where I wanted to share that PPT with you. I'm just not getting it. Let me check up in another source. Yeah. So I will share the screen for so this is my personal contact which you would be knowing. I just wanting not to show the coaching class name. So about my name and my contact details. No coaching class there. So Ind AS fair value measurement only for balance sheet item only. This is for assets as well as for liabilities and equity, especially own equity instruments. So the focus for 113 is on balance sheet items only and on assets, liabilities and own equity instruments. One moment. It has got nothing to do with other than balance sheet. And this particular accounting standard is not targeting any particular event or a particular asset. It is a strong source of inspiration for other accounting standards. So whenever fair value is taken up for discussion They got to refer only to this. So this by itself, I would consider as a lighthouse. Lighthouse, I think all of you be knowing that for all the ships, for all the marine vessels, in order to be guided to get into the nearest berth of a particular port, you have this lighthouse. Likewise, this by itself is not having something like reporting, disclosure and all that for a particular item. They just, this is like a dictionary, I can tell for sure. Role of Ind AS 113. This is like a lighthouse. I remember that. Or it is like a dictionary, as I told you. It enables the purpose of other accounting standard, does not mandate any reporting or disclosure requirement in this particular accounting standard. So it is an ideal scenario, and it has got nothing to do with as a direction towards how it is to be reported and disclosure. Any accounting standard for that matter will have like what you have as recognition, measurement, reporting and disclosure. So this, they talk something about measurement and before that the recognition, but it is not covering up reporting and disclosure. What is generally is to be considered as a fair value? Fair value would mean between two market participants in a willing scenario, the sale value of an item, especially the asset, where the person should have possessed that. Now let us just have a better understanding on the subject matter. Items dealt are assets, liabilities and own equity. When the parties are related parties, and the other scenario is they are unrelated parties, the price cannot be considered to be at arm's length price if you deal with related party, and if they are unrelated party, then we will consider the price as arm's length price. Comment is that you can conclude that any transaction between related parties will not be taken up as fair value. So between unrelated parties, the price will be taken up as fair value. This is a common sense understanding anybody would be having. So arm's length price equal to fair value. What is a fair value? Fair value is only an estimation of price. In an orderly transaction, to sell an asset or transfer a liability between market participants at a measurement date under current market conditions at exit price from the perspective of a market participant that hold asset or liability. So there are 7 items that you have. All the 7 items are very important. Firstly, it is an estimation of price. So it is not an actual price. It is only an estimation. Estimation in an orderly transaction. So thing is that what do you mean by orderly transaction? Say when any transaction is to be done on an out of order, then the price is going to be higher. See, for example, I will give you an example. If I have to upload, there is approach for getting a passport. So for the passport, it will take 3 weeks to 6 weeks period, and it has got a price. But there can be a citizen who would be getting all of a sudden an information to join for employment or for any emergency meeting or something like that, where it was not a planned one, it is an unplanned one. Without passport, you cannot proceed. So if you cannot proceed without a passport, where you have a week's time to proceed. So on emergency cases, I might approach the local passport officer telling my scenario, saying that all of a sudden I got an admission for this particular university, which I did not expect to happen now, because they are changing, the university is changing from semester to trimester. And I was just thinking that it can be taken up 6 months later, where I was thinking of renewing the passport a little later. Now it got expired. Now I want the passport. So quite naturally, the price what they would charge for an emergency scenario will not be the same as people would normally be coming in the order. So please understand, in an orderly transaction is only that meaning. So whenever you have a distress, whenever you have an anxious moments to effect a sale before a particular period, or when the scenario is a distress scenario, the price will not be fair. That is the reason as why we say estimation of price in an orderly transaction to sell an asset or transfer a liability, not for buying, to sell an asset or transfer a liability, and between two market participants. It is not a quotation that is being generally available that could be taken up as a fair value. Between two market participants, one will be a buyer, the other one will be a seller. So, yep, that is my estimation of price, that when I have a property where I'm just thinking I should be getting so much of money because I have so much of liability. That is not the one. So, between two participants where one person is to sell, the other one person is to buy at a measurement date. So, very important is valuation on a particular date under current market condition. So, we are not going to talk about a forward market. It is about the current market condition at exit price from the perspective of a market participant that hold asset or liability. Exit price is always a selling price. Of course, we have affected in the third point to sell an asset or transfer a liability. So, these are the very important points that you have. So, please be careful with that. Fair value base. So, the item that you are effecting for sale could be identical with another one that I have. Supposing I am having 500 shares of Reliance company where I want to know what is the price. How do I just check up? So, similarly, Reliance shares are available which are identical. That price is going to be the price here. So, that is a market base, and this one you call it out as a level 1. Similar is different from that of identical. Identical, same. Similar would mean majority same, some portions are different. So here I will not be in a position to take a market base where I will be bringing out some adjustments to bring that value. So imagine that motorbike to motorbike you can match, they are identical. Motorbike to scooter, they are similar only. So I got to bring about the adjustments to bring out the value. Just a matter for the purpose of checking. So maximize the use of relevant observable input. So since I do not have the market base, I am expected to use the relevant observable input. Then others, neither identical nor similar would mean which is very much unique. And what is that we are expected to do? We have to do an independent analysis. Independent analysis where I am expected to not to use, minimize the use of unobservable input. What is an observable input and what is an unobservable input? Observable input are which are available. Unobservable inputs where I got to bring out some assumption and try. So it is not that they prohibit that you should not be using. They say minimize the use of unobservable input. So for identical, pick up from the market, or in the case of similar, make those changes and try to maximize the use of relevant observable inputs, whereas in the case of others, independent analysis will be the basis and minimize the use of the unobservable input. So now let us just take up the fair value shall be assigned for assets and liabilities, and shall not take into account the restriction of the entity on the use of an asset or liability. What do you mean by that? See, always remember, see, many a times students generally they don't pay attention to this particular accounting standard. In my view, 105 and 113 are not studied properly by students. So my recommendation is that from the viewpoint of professional application as well as for examination purposes, this is very, very important. So to be fair to tell you about this, I am an valuer under IBBI on financial assets. There are few assignments I do get alongside of the audit. So many a times what we study in AF firm, that being SF firm, financial management, we are using it in this particular case for valuation purposes. So see, the clients are a good clients. They're all industrial giants in South India and Asia as a whole. So they bring into our table a lot of challenging scenario where we may have to go through those basics what we have done in our subjects. It's not that the subjects that we study are theoretical. Mostly they are all practical only. So please be careful, study with greater care. So wherever you join and whatever profession that you are going to take it up, they will be of great help to you. So in case an asset has got some restriction, whether you are expected to use that particular restriction. Say for example, so when you find promoter shares cannot be disposed of for some period of time because you have SEBI is expecting to have some so SEBI is expecting to have some lock-in period for them to do it. So whether you will be taking up that sort of restriction in evaluating the shares, if you ask a question, so what they say is that shall not take the restriction of the entity on the use of the asset or liability. Please ignore that for the purpose of doing that. So investment held by us, held in subsidiary, not subsidy, subsidiary. Subsidiary cannot be sold by a parent immediately after the IPO of the subsidiary. Fair value shall be applied on the investment as if shares can be sold immediately. The lock-in period, not look-in period, the lock-in period, typographical error, sorry for that. The lock-in period restriction shall be ignored. Fair value of the shares without restriction is expected to be greater than the fair value of shares with restriction. Consider the fair value of shares without restriction for fair value if investment is held by the parent. So that is what we are expected to have. 113 cannot be used in the following NDAs: AS2, AS36, 102 and 116 because they have their own fair value measurement. In the case of inventory, what is that you have? We have cost or NRV, whichever is lower. Say, when they have an independent measurement scale, 113 has got no role. So they will say, please just get away. Don't come here because we have exclusively an accounting principle there. I mean, measurement principle we have. Impairment of assets. What is that? Carrying amount versus recoverable amount. Recoverable amount is nothing but the higher of the two. Right. So therefore, it has got its own thing. And 102, you have ESOP, ESPP, and stock appreciation rights. In all these cases, you do have, I am going to add one more also, which is not mentioned in the accounting standard, which I am going to tell you in the AS 41. Even here also, you cannot have this accounting standard coming there to apply. So 116, it has got its own measurement scales. So measurement principles that we have in 113 will not be applicable there. So fair value concept is different in these accounting standards, and in the AS 113 has no application whatsoever. Example, in the AS 2 as NRV, which is identical to fair value less cost to sell. So fair value less cost to sell is the base at which biological assets ought to be recognized at the time of purchase. Yes, that is what I told you. Is fair value to be invoked only on a balance sheet date? No, it can be applied at any point of time. It can be applied at any point of time. That day shall be referred to as what? Valuation date or measurement date. So why I wanted to spend extra bit of time for this is that I wanted to tell you that this is a very, very important accounting standard. many times students or many students fail to apply in this particular area. Very, very nice accounting standard. Definition, this of course, that 7 points that we were noting down, same thing that you have. I'm just quickly making. What is to be understood for market? So, principal market and what is the other one that we will be taking up? The other one is MAM, most advantageous market. What is the principal market? If the item is available, price of this market is considered to be fair value. Principal market, where you find the assets are sold at highest volume with higher level of activities. Example, you take up financial assets, the shares of Reliance company, which of the two markets that you have, that could be taken up as a base for bringing out the fair value. Is that NSE to be taken up or BSE to be taken up? They have mentioned it, where you have highest volume with higher level of activities. That's a place where you got to take up. Most advantageous market would mean where you do not have this principal market, you have to take up for most advantageous market. So principal market normally for identical, for level 1 activities you can take up. For level 2 and level 3, you take up most advantageous market. What are the treatments if the transaction cost and transportation cost? So all of you please just understand, this is a very, very important area. People might just simply be not understanding the concept well. I will try doing this problem and this particular discussion, and out of that immediately we will solve one problem. So in this particular case, in the principal market, transaction cost has got to be ignored because greater volume and normally transaction cost will be negligible, insignificant, you can tell. That is the reason why it is to be ignored. So in the most advantageous market, that is going to be a very important component. So that should be considered. In all other places, we are expected to consider. Transportation cost, consider. Here also consider. There is only one. Transaction cost in principal market should be ignored. In all other places, you should consider. Now, with this, I would like to take up one particular question that we have in our material given. So 113 fair value measurement. Question number 1. An asset is sold in two different active markets at different prices. An entity enters into transactions in both the markets and can access the price in those markets for the assets at the measurement date. In market A, the price would be received is 26, transaction cost in that market are 3, and cost to the transport the asset to that market are 2. In market B, 25, 1 and 2. You are required to calculate the fair value of the asset if market A is the principal market, and the fair value of the asset if none of the market is principal market. Now, how is it we are expected to answer for this particular question? If market A is the principal market, what is the fair value? Fair value, where they have mentioned it very clearly. So for the first part of the question, market A is the principal market. What is the fair value? Fair value 26 I will take up. Transaction cost I have got to ignore, but I am expected to take up transportation cost. So it is 26 minus 3 minus 2. This minus 3 should be ignored. That is the reason as why I have written and then cancelled. So that's my style. The answer is 24. Right. Then for the purpose of when the fair value of the asset, if none of the market is a principal market, I need to know what is the most advantageous market. So what is that I am expected to do? Most advantageous market I got to do. So if I take up A, most advantageous, how to arrive at? So how to arrive at MAM, most advantageous market for A and B, where I am expected to take up all items 26 minus 3 minus 2, 21. B, 25 minus 1 minus 2, which is equal to 22. Now, which one is most advantageous market? The most advantageous market would be B. Why? 22 is greater than 21. So, how did you arrive at most advantageous market where I get better price? Then fair value of the asset is none of the market is principal market would mean now most advantageous market is B. Now having taken up B, then the answer will be 25 minus 1 minus 2 would mean this minus 1 should not be taken up. Answer to that question is 23. Answer for the first question is 24. Answer for the second question is 23. So now let us just check up with our institute study material. I will stop for a moment, then I will show you our institute study material. Say now let me just share this. Now see this, if market A is the principal market, if market A is the principal market for the asset, that is market with the greatest volume, greatest level of activity for the asset, the fair value of the asset would be measured using the price that would be received in that market after taking into account only transportation cost. So therefore it is 24. If neither of the asset is a principal market, the fair value of the asset using the most advantageous, how do you arrive at 21 and 22? Since the entity would maximize the net amount that would be received for the asset in market B, 22, the fair value of the asset would be measured using the price in market B. Then after doing that, then we are expected to deduct only the transportation cost of 2 to arrive at the fair value of 23. So we are expected to arrive at the value as 23. This is what you do have. So now we are halfway through in the class. We will have 10 to 12 minutes of break where I got to have something and then we will be back. Okay. So for a moment, I will not be sharing and keeping in mute and stop the video. We will meet after 10 to 12 minutes. Hi. Let us resume the class. This is about how principal market and most advantageous market has got to be taken up. Financial and non-financial. This is the place where I wanted to tell you about what is financial assets. Financial assets are investment in security shares, etc. Then non-financial assets are land, building and other properties. For non-financial assets also we use fair value. Use for fair value purposes, highest and best use. Khusbu. Highest and best use method is always assigned for non-financial assets. What do you mean by Khusbu? Highest and best use. It is a fair value measurement for any non-financial asset. It indicates the ability to generate economic benefits by using or by selling. Any asset for that matter, a person is holding would mean he will use it. If that usage is not there, he will sell it. Non-financial assets do not have frequently traded market like financial assets. Quite naturally, land, building, property and all that, they may not be having a high frequency as you have in the case of financial assets. Best possible use may be different for each entity. How you use the asset is very important. That is the way value can be assigned. It is not necessary that we have got to exhaust all the possible ways of usage. The current usage itself will be taken up as the best usage. That is what we have said. There is no need to exhaust all possible uses. In the absence of potential best use, which is not easily available, its current use will be the best use. We shall take into consideration for such cases, physical, legal and financial use shall be considered in measuring the fair value. Is financial value applicable only to assets? No, liabilities also. And own equity instrument also will have that. And we can just limit our learning of PPT up to this particular stage, and we will stop at this moment and we shall proceed for cracking the problems. Okay. Considering the time constraints that we have, we will take it up from here. Question number 2. Question number 2, ABC Limited acquired 5% equity shares of XYZ for 10 crores in the year X1 and X2. The company is in processing of preparing financial statements for X2, X3 and is assessing the fair value of the at subsequent measurement of the investment made in XY Limited. Based on the observable input, ABC identified a similar nature of transaction in which PQR Limited acquired 20% equity shares in XYZ for 60 crores. The price of such transaction was determined on the basis of comparable companies method CCM enterprise value to EBITDA, which was 8. For the current year, EBITDA of XYZ is 40 crores. At the time of acquisition, the valuation was determined after considering 5% liquidity discount and 5% of non-controlling stake discount. What is the fair value of ABC? What will be the fair value of ABC's investment in XYZ as on the balance sheet date? See, now let us just take up the matter for discussion. One moment. Now the matter is relevant upon these things. Now let us just take up question number 2. ABC Limited is holding 5% in XYZ for 10 crores. That is by X1, X2. The company is in the process of preparing for the financial statement for X2, X3 and is assessing the fair value subsequent measurement of investment in XYZ Limited. So they want to value it by X2, X3. That is 31st of March, X3 is the date on which they want to know the value in XYZ Limited. Based on observable input. So that means it is not identical. It is somewhat similar nature of transaction. A proxy company PQR, you have taken a so PQR in XY Limited 20% they are holding for 60 crores. The price of such transaction was determined based on comparable companies method CCM, where you have a measure of enterprise value divided by EBITDA is expected to be 8. Enterprise value is equal to EBITDA multiplied by the multiple which is 8. For the current year, EBITDA of XYZ is 40 crores. So 40 into 8 is going to be 320. And this company's investment is 5% on 320, it is going to be 16. Correct? At the time of acquisition, valuation was determined after taking into consideration 5% liquidity discount. 5% for non-controlling interest, that is non-controlling stake discount. What do you mean by that? We have on 16, we need to deduct towards 5% for liquidity discount. What do you mean by that? So since it is not a company where it is listed, to sell this shares, you may have to discount it. I mean, since the saleability has got a restriction in the sense that it is not widely sold, you need to explain, and the possibility of affecting sale is very less. So deduct 5% for that purpose. And since you are not holding majority shares, you are holding only a small portion. For that also another 5% you reduce. So in a way you reduce 10% you can tell. So it is 16 crores minus 10% on 16 crores. It will work out to 14.40 crores. So answer for this particular question is just like that worked out, and the answer is 14.40 crores. Is that clear? This is what we will understand by going through question number 2. So fairly a very simple question, simple area only. It reminds you of AFM, and definitely you will be in a better position to take it up. Now let us just take up on to question number 3. This is also on 113. UK Limited is in the process of acquisition of PT Limited. So acquirer, acquiree, as a part of business reorganization plan. Projected free cash flow of PT Limited for the next 5 years given, and terminal value they themselves had provided at 3,965, and the average cost of capital of PT Limited is 11%. So these are all future cash flows only. They have not discounted, and we are expected to deduct from the total value of the enterprise the debt, so as to find out the value for equity where they got to pay for that, and all this will bring out the core section of the asset, and from that total value, enterprise value, we are expected to deduct debt, and we are expected to add towards non-productive assets, which is cash and cash equivalents 106.14, because the cash flows are generated out of the use of core assets. So for the non-core items, we are expected to add this non-core cash item, and we are expected to divide the value by 8 crore 52 lakhs 84,223 shares, so as to arrive at value per share. Now let us just take up Excel sheet for this purpose and work that out. Year number 1, 2, 3, 4, 5 and 5. Events are free cash flow of the firm, number 1, up to 5, then terminal value. Cash flows are 187.1, 187.6, 121.6.8, sorry. 269, 278.8, 3,965. 3,965. PV factor to be counted at 11%. So we are expected to arrive at the sum of all this coming out to 3105.77. This is the total enterprise value. From there, we are expected to deduct debt of the entity given as 1465. Then add cash and cash equivalent. Cash and cash equivalent 106.14. Total equity value. Number of equity shares. These are all rupees in crores. That is, this is also so many crores, 8 crore 52. 8.52, 84223. 85284,223. Value per share. This divided by this. Totally it comes to 204.83 is the final answer. So you can have some solace in FR paper where it is almost similar on, that is similar to that of AFM that you have, not much of a difficult moments that you have. You need to be a little more careful in handling as what values are to be added and deducted. And with that, I would consider that one more problem with that we will complete this almost on the same lines that you have in the case of next one. You are a senior consultant of your firm and are in process of determining the valuation of KK Limited. You are determined the valuation of the company by two approaches, market approach and income approach, and selected the highest as the final value. However, based upon the discussion with your partner, you have requested to assign equal weights to both the approaches and determine a fair value of shares of KK Limited. The details of KK Limited are as follows: valuation as per market approach, income approach, debt obligation, surplus cash. Like the last, the data are all on the similar lines. Then apart from that, you do have surplus value of fair value of surplus assets and liabilities 312.4 and same 8.5 to 84223 shares that you have. Determine the equity value of KK Limited as on the measurement date on the basis of the above details. Now 50-50 equal weight is what they are expected to use. So now let us just take up these two, or I would like to take up all the data and copy it in the Excel file and for usage to be made. So instead of yes. So to that extent, we can keep that and work it out. Okay. Valuation of shares of KK Limited. Method, market, income, value, 5268.2, 3235.2. Weights, 0.5 each. Weighted average value. So what you get is 4251.5. We are expected to deduct debt is same. So here 0.9 and cash equivalent 106 point that. Then cash and cash equivalent, and then one more we have got to add. Surplus assets. $312.40. Total enterprise, total value of equity. Total value of equity. $3204.34. Then number of equity shares, and when you take up value per share, it comes to 375.72. So quickly we have finished. So we get that satisfaction that the problems are of similar in nature and with not much of a complication that we have. So with that, I would just say that Ind AS 113 is over. So in this process, today we have just taken up on to Ind AS 1, Ind AS 7 and 113. Right. Now let us just take up at this moment a problem on Ind AS 115, see, which is a vast accounting standard, revenue recognition. We will revisit this. We will revisit this, and I would like to take up from our institute study material on to so this is considered to be one of the very good problems that we have in revenue recognition. On the other day, we have solved one problem that was related to when there was a variable consideration, how you got to take up that, and we got that computation. So here more of concept discussion only we have, not on computation that you have, whereas in this problem will have both concept as well as computation. So mark illustration number 55 in our institute study material as very, very important. Now let us just take up on to question number, illustration number 55. So allocating a discount. An entity regularly sells X, Y, and Z individually, thereby establishing the following standalone selling prices. product X, Y, and Z standalone being 50,000, 25,000, 45,000, total being 120,000. In addition, the entity regularly sells product Y and Z together for 50,000. Case A, allocating a discount to one or more performance obligations, the entity enters into a contract with the customer to sell X, Y, and Z in exchange for 100,000 rupees. The entity will satisfy the performance obligation for each of the products at different points in time, or product Y and Z at the same point of time. Determine the allocation of transaction price or to product Y and Z. Case B, residual approach is appropriate. The entity enters into a contract with the customer to sell X, Y, and Z as described in case A. The entity will satisfy the performance obligation for each of the products at different points of time, or product Y and Z at the same point of time. Determine the allocation of transaction price to Y and Z. Case B, a residual approach is appropriate. The entity enters into a contract with the customer to sell product X, Y, and Z as described in case A. The contract also includes a promise to transfer product alpha. Total consideration in the contract is 130,000. The standalone selling prices of product alpha is highly variable because the entity sells product alpha to different customers for a broad range of amounts, 15,000 to 45,000. Determine the standalone selling price of X, Y, Z, and alpha using residual approach. Lastly, case C, residual approach is inappropriate. The facts as in case B apply to case C, except the transaction price is 105,000 instead of 130,000. So one moment, I will just join. Now, how do we handle this particular case? What is this problem all about? This problem is all about is coming into in stage number 4, allocation of performance obligation to transaction price. So how do we allocate the combined price for individual items? Standalone prices they have given. So it is on to illustration number 55. Illustration number 55 of Ind AS 115. So what is it they have mentioned here? X, Y, and Z given as 50, 25, and 45. Total of that comes to 120,000. But they also have the habit of selling Y and Z for a total sum of 50,000. So products are X, Y, and Z standalone selling price. SASP stands for standalone selling price, given there as 50, 25, and 45. So they given a scenario Y and Z can be sold for 50K together as a combo. That is what they said. Now allocate the discount to one or more performance obligation is what they mentioned. Now the entity, all the three together is sold for all X, Y and Z sold for rupees 100,000. Now we are expected to take up. Now we are expected to take up as how this 100,000 has got to be taken up. So we can take up Y, X and Y and Z together. Y and Z for which the combo offer is given as 50,000. And therefore the balancing figure I will keep it at 50,000 for X. So between Y and Z, how that 50,000 will be taken up? Y and Z, where Y will be taken up at 25,000 and Z will be taken up at 45,000. 25 divided by 70, 45 divided by 70. And how much it works out to? So 50,000 into 25,000 divided by 70,000, that comes to 17,857. 50,000 into 45,000 divided by 70,000, that comes to 32,143. So we understand that how that 100,000 is getting distributed. So in this particular case, they are distributed as breakdown of rupees 100,000 is 50,000, 17,857 and 32,143, totaling up for 100,000. So that is what determine the allocation of price to Y and Z, even X also. Next one, residual approach is appropriate. So case A we have done, case B, so where we have case B, residual approach is appropriate. Here X, Y, Z, and we are expected to have one more product that is called as alpha, and the price is 130,000. Now it is X, Y, Z and alpha as 50,000, 25,000, 45,000, and this alpha is, they have not given as a fixed price. This ranges depending upon various scenarios where they have given the range from 15,000 to 45,000. The standalone price of product alpha is highly variable because entity sells product alpha to different customers for broad range of amounts. So it depends on the type of market supply, etc. They decide minimum price 15, maximum price 45. So we are taking up an average 15,000 plus 45,000 divided by 2. So a mid price of 30,000 we can take it up. So the combination of all this, now the price is 130,000. The price is kept at 130,000. That is what they have mentioned. Determine the standalone prices of X, Y and Z and alpha. So here the difference between case 1 and case A and case B is 30,000 rupees increase. Correct? So therefore, I would like to do it in the same fashion as it was just done in case number 1. So now I will just give you the rupees 130,000 breakdown. This 50,000 will continue to be there as 15,000. 17,857 I will take up. 32,143 I will take up. For alpha 30,000 I will take. Total 130,000. This is easier than the last one. So that amount of increase in the price is only on account of alpha. Alpha is roughly sold at an average price of 30,000 and that is the way we are taking it up. Then we have the residual approach is inappropriate because the transaction price got shrunk to 105,000. Case C, X, Y, Z, alpha, standalone price, 50,000, 25,000, 45,000 and this being at 30,000 and where it is going to be 140,000. Correct? Sorry, 150. How come? 75 and 75, 150,000. So now breakdown of $105,000. Breakdown of $105,000 where discount cannot be taken up. We cannot take up this at 50,000 and when you take up this as 30,000, so you cannot have the balancing figure. That is what they said, residual approach is inappropriate. When residual approach is inappropriate, the only way that we can allocate this 105,000 is in the same order, in the same proportion as the standalone price that you are having. How come? 50K to 150K on 105,000. 35,000. One moment, there is a person on the door. $35,000. 25,000 divided by 150,000 multiplied by 105,000. 17,500. 45 divided by 150 into 105. 31,500. 30 divided by 150 multiplied by 105 is going to be 21,000. So, by and large, conceptual discussion is what we have it in the case of revenue recognition. Computationally, they are not challenging, is what I would tell. Conceptually, where you need to be a little more alert. So, this is what I would consider 115 as a case, whereas in the case of 116, conceptually and computationally, you have to be very, very, very alert. Okay. So, with that, I would say to the extent of 115 is over. We may revisit when time is permitting, okay? Now let us just take up on to Ind AS. Ind AS 1 or 2, share-based payment. Okay, I will try to share the PPT there. I will stop for a moment. So let me just check up. Okay. So from see, not PPT is not that comfortable. So now let us just take up on to our own discussion. Okay. So share-based payment, what is considered to be a share-based payment? Immediately our mind will just go for ESOP, ESPP, and share appreciation rates. But any payment in lieu of cash where shares are issued will be taken up under share-based payment. So we do not have the matter related to business combination. There also purchase consideration is settled only in the form of shares. We do not envisage those items that we will in financial instruments. That I am going to reserve it for class number 7 and 8. Financial instruments I have not touched at all. So in this today being the 6th class, we are around 20 accounting standards or so we have just touched. So please just understand that share-based payment is very unique. So generally it is associated with ESOP, employee share purchase, there is purchase plan, employee stock option plan, employee stock purchase plan, and SAR stands for stock appreciation rights. So in the case of option plan, the fair value of the option will be static. The figure will remain the same at all levels, at all points of time. In stock appreciation rights, the fair value of the rights will be dynamic. Will always be changing. See, now let us just understand basically the difference between employee stock option plan and stock appreciation rights. Let me tell you what is that basic difference between the two. Employee stock option plan, in which the intention of the employer is to retain the employee for some number of years, giving them the incentive of subscribing to the shares after the vesting period at a price lower than the expected market price, so that by subscribing at a lower price, the employees can subscribe at a lower price and sell it at a higher price, make a fortune, and that is a sort of benefit that he will be deriving, and that being the incentive for the employee to continue with the employment. So this fair value of the option will be static, and whatever value that you have on the grant date, the same value will continue to be there. I hope that all of you will be knowing about 3 dates. This is the grant date, this is the vesting date, and this being the expiry date. So the date of announcing the plan is what you call it out as grant date. The date on which he is eligible to subscribe, that is a vesting date. There will always be a period that they will be providing for subscription. You call it out as exercise date. Exercise date. After that, he cannot have the eligibility for exercising. So by offering the shares at a price less than the market value, definitely the employer will be losing the profitable opportunities of getting money from the general public, which they would be sacrificing in favor of the employees at a cheaper price, and therefore the difference between the market price and the exercise price, we can take it up as a loss the employer who is sustaining, and therefore the amount of loss should be spread across the vesting period. This period we call it as a vesting period. So we are expected to amortize the concession offered by the employer for that particular period, which you call it as vesting period, whereas on the exercising period, no amortization is expected to be there. So the vesting period under which the amount which is expected to be amortized will be debited to profit and loss account. We are expected to take credit to ESOP reserve account or outstanding account, as the case may be. And once a subscription is made at a price that they have agreed upon, we are expected to debit cash for the collection of cash. The concession we will be debiting to ESOP reserve. Credit will be given to the face value of the equity capital and security premium. The balance, if any, left over in ESOP account shall be transferred to other retained earnings or other equities in the statement of changes in equity. Let me repeat. At the time when it is exercised, debit cash, debit ESOP reserve account, credit cash, credit equity capital, credit security premium, and credit to other equity for the amount that they have excessively taken to ESOP reserve, which can no longer continue to be there, that will be taken to other equity. This is the scheme of journal entry that we are expected to pass. And the fair value of the option is why it should be static is that the exercise price will be static. Exercise price will be fixed. Therefore, the fair value of the option will also be a fixed one. So, since the exercise price is fixed, the fair value of the option will also be fixed. Now, let me just compare this with SAR. When employee stock option in which it is to be successful, the person has to contribute money. Contribute money towards contribute money towards money towards capital of the entity. Correct? Now, to make this ESOP working, we expect the employees to be financially sound to subscribe for the shares offered to them. So, why would ESOP may not be successful to 100%? To 100%, it should be successful, no, but you would be finding that some of the employees may not participate at all. Not because that it is an illegal money or a gambling money. It's not because of the ethical problems that they are not participating. But when 1,000 shares were offered to each, and each one is going to be say for 5,000 rupees or so, imagine that how much of money that they got to put in. 50 lakhs of rupees an individual to bring in to subscribe for the shares, even if it were to be held for a period of 1 or 2 years with a lock-in period and all that. So I don't think so employees will have that amount of liquidity to wait for the fortune to make a profit. Not many will have that. So therefore, because of the liquidity problem alone, some of the employees would not be willing to contribute even though they are having urge to contribute. Because of the inability to mobilize the funds, you find them not participating. So therefore, you would be finding amongst the employees, you would find a disgruntled employee will be there. Yeah, people always be in this world craving for recognition. And when you find a scheme applicable only for those who are financially sound to participate, and we find other employees not able to participate because of the liquidity, there will always be a gap that you are creating. There is going to be a gulf. There is going to be a discrimination amongst the employees when you seed or when you pave way for that. That will automatically be shown in the work, performance, efficiency, and whatnot. So the purpose of giving or the purpose of issuing ESOP will get defeated because of this. So for example, if Tamil Nadu government were to provide 1,000 rupees for each household, would mean So people criticize, people appreciate. But for the promises which they wanted to employ, that is apply, implement, then they have just removed 50% of them, saying that you are not eligible and all that. So by paying money and putting the exchequer to a very big strain and burden, the Tamil Nadu government had earned the wrath of people who did not get that 1,000. So those who got the money, it is not a guarantee that they will vote for this particular government, but it is for sure that those who are denied with that cash will be working against this particular government, which is very easy stuff for anybody to visualize. Same scenario is what you have it in the case of an employees also. You would be finding one set of employees who can contribute that liquidity, make huge fortune. Another set of people we find they do not have the liquidity, then they are denied of that fortune. Definitely it is going to be acting as a demoralizing effect. So instead of making up ESOP, many of these entities will prefer to have stock appreciation rights. The point is not to discuss politics. Many people are concluding that I am talking politics. No, people know politics better and the effect of politics better. So therefore, I am employing it in this particular case. Stock appreciation rights. So you apply the same scenario in the case of stock appreciation rights. You do not expect the employees to contribute money, but had they contributed money and sold out the shares at a price higher than the subscription price, definitely that amount of profit, if you provide as an employer, then there is no discrimination amongst the employees and all of them will be happy to take money. Nobody will have indigestion problem for vitamin M. Even the richest person will not say that he has got indigestion problem for vitamin M money. And everybody would be requiring money. What for you require money? The same purpose for which money is serving for me also. So therefore, stock appreciation rights would be superior, far superior, and where employer will provide in that a subclassification as one with no share option, then the other one is with the share option. What do you mean by that? So I provide this way, you don't have to subscribe would mean you come in this particular category. There can be another type of person who would be saying, I don't want cash, you please give it in the form of share. So therefore, SAR is an improved version of ESOP where you have two types of SAR, one with no share option or only cash option. The other one is with share option that you have. So we will be in a better position to understand this through a problem. Now let us just take up that. So I would like to take up question number 2. P Limited granted 400 stock appreciation rights SAR, each to 75 employees on 1st of April X1 with a fair value of rupees 200. The terms of the award require the employees to provide services for 4 years in order to earn the award. The fair value of each SAR at each reporting date being as follows as 210, 220, 215 and 218. What would be the difference if at the end of the second year, that is 31st of March X3, P modifies the terms of the award to require only 3 years of service instead of 4 years of service?
Now let us just take up. So it is not going to be a provision that you got to make, it is a liability. So in the case of employee stock option plan, we cannot judge for sure how many of the employees will exercise that. You cannot force somebody to exercise. So on their own volition, you find that people would be subscribing 90% they will be taking up, 10% they may not take up at all. Where you need to estimate and provide all this. In stock appreciation rights, there is no question of provision, it becomes a liability where you can determine the liability. It is not a provision. If that be the case, how the amount has got to be worked out, now let us just see. $400 into 75 into 200. $60 lakhs. And we are expected to take up only 1/4 of that at that point of time. Why? Because the term of the award is to provide service for 4 years. So therefore, I am expected to find out the closing SAR position divided by 4, 15 lakhs. 400 into 75 into, sorry, it is extremely sorry, it is 210. I have committed the mistake. 400 into 75 into 210. 63 lakhs into, or I will put it this way, into 1 by 4. 1575,000. Second year into 2 by 4. Why 2 by 4 is that? 1 by 4 is number of years lapsed divided by the total time. 1 year gone out of 4, 1 by 4. Next one is number of years lapsed will become 2 years out of the total time of 4. So therefore it is 2 by 4. So it is 400 into 75 into 220. All that works out to 33 lakhs. And how much is the expenditure for the second year alone? For the current year, it is going to be 15 lakhs 75,000. Which is going to be 17 lakhs and 25,000. How come? 33 lakhs minus 15.75. Next one, 400 into 75 into 215 into 3 by 5. 3 by 4, sorry. 48 lakhs 37,500 minus 33 lakhs. So which comes to 15 lakhs 37,500. How come? 48 37,500 minus 33 lakhs. Next. 400 into 75 into 218 into 4 by 4. Which is equal to 65 lakhs and 40,000 minus 48 lakhs 37,500. That becomes 17,02,500. So then, what is the journal entry that we are expected to pass? Question number 2, Ind AS 102. Year number 1, debit employees cost 1575,000, credit SAR liability. Then debit profit and loss account, credit employees cost 1575. So SAR outstanding will be 1575. Then year number 2, let's just check what exactly was the question. What would be the difference? We will take up that. I am just explaining it completely. Debit employees cost 1725, credit SAR liability 1725, debit P&L, credit employees cost 1725, and SAR outstanding is expected to be 3300. Year number 3, journal entry scheme is going to be the same. It's only the number that will be different. $1537.5, year number and SAR outstanding will be 48,37,500. Year number 4, so that point of time 17,02,500. And SAR outstanding is going to be the full amount of 65 lakhs and 40,000. See, that point of time when the vesting is over, then SAR liability 6540, credit is given to cash 6540. So stock appreciation rights at that point of time will be paid in full. Correct? Okay. Now the question is, what would be the difference if at the end of the second year itself you are shortening the period by 1 year? So this got over at the end of the second year. You just get the feel that you can finish it off in 1 year. How the same has got to be taken up? So all of you closely follow the above computation. I will change by, instead of 2 by 4, it will be 2 by 3. Right? Because the total time is getting reduced from 4 to 3. So therefore, it is 2 by 3. 400 into 75 into 220 into 2 by 3. 4,400 minus 1575,000. So this comes to 2825, and by 215, 400 into 75 into 215, which is 6450 minus 44 lakhs, which is equal to 20 lakhs and 50,000. So these are the changes that you can be expecting. Is that clear? So if you know the scheme of journal entry for that particular point of that particular part of the question, I think you should be in a position to apply for the changes that you are finding there. Okay. So when time is permitting, we will go a little deeper onto this, and we can solve problems on stock appreciation rates. I hope that we have given a fair representation to 102 with the available time. You will get back when time is permitting. Then comes now NDAS 8. This has got a parallel accounting standards as of that of the old one, that being the old accounting standard AS 5, you have it now as NDAS 8. Now let me just check up as whether we have a PPT for this. I will stop sharing now. So I would like to try not on NDAS 8. I would like to take up 108 operating segments. Change of plan, because PPT is available for 108. Now let us just try this. NDAS 108 operating segments. So the earlier one was segment reporting. So companies where you find A is applicable through Companies Act, 2013 only when notified. For companies not required to apply 108 but chooses to disclose without complying to NDAs cannot describe information as segment information. So let me tell you what exactly is the background of segment information or segment reporting or operating segment. What is the background? People are not having the time to go through in a very detailed form the financial statement at all times. Of course, they do have time on certain occasions, but not on every occasion. So, decision maker would require from the financial statement the very important ones. I'm not talking about or supporting any interim financial reporting. I'm talking about to know about the strength as from where they are getting the strength. We need to know. Even in the cricket also, they put very clearly the wicket keeper as WK and indicate for batsman only with a bat sign and bowler with a ball, all-rounder would mean both. So, what is the strength of the team would mean how many all-rounders you have. In all-rounders also, how many of them are specialist bowler where they can bat, specialist batsmen where they can batter, where they can bowl also. See, that is composition of a team we would like to know. Same way, an entity might have different projects that they would be taking up or different portfolios they may be having. One may be giving them loss, another one may be giving profit. They would like to know what are all the segments which are profit making and loss making, and through certain turnover test, results test, assets test, we would like to classify them as whether they are operating segments or otherwise. Segment information is applicable in the case of consolidated financial statement when SFS as well as CFS are prepared by an entity. Is the component able to earn revenue? See, what will happen if it were to be no, we will take it up. Or the component results reviewed regularly by chief of decision making or CODM, chief of decision maker. Or you can consider that if it were to be single person CEO. Is discrete financial information for the component available? Yes. So, for all these questions, if you have anything or if you have no as the answer, not an operating segment at all. This is what we find in 108 provider. An entity shall report separately each operating segment that is identified by the management or results from aggregating two or more other segments and exceeds the quantitative threshold. Quantitative threshold where the basis being revenue, result and the assets. Aggregation criteria. Each operating segment, two or more segments may be aggregated or grouped into single operating segment. See, always remember, for specialization purposes, entities may separately provide such as manufacturing and service. Imagine that a company is engaged in washing machine manufacturing, television manufacturing. So you would be finding manufacturing as a separate entity or separate segment. Servicing that washing machine may also be done separately for specialization. But when you take up as an operating segment, you have to take washing machine where you have to take manufacturing and servicing as one unit. That is what they say. Two or more operating segments may be aggregated, grouped into single operating segment. And if aggregation is consistent with the core principles set out in 108. So you may consider them as bowler, you may consider them as batter, and if you have both together, you call them as all-rounder. Like That was the basis I was just telling you as how normally we use elsewhere. Same thing is used in financial reporting also. Types or class of customers, nature of production process, method used to distribute, then nature of regulatory environment. So on variety of basis you can aggregate. On what basis you aggregate? So nature of production process, type of customers or class of customers, methods used to distribute. There can be different ways of doing it. Say for example, the population of India can be classified based on gender, based on literacy, based on nature of employment, based on age. You can classify on any basis. You can do that. Impact in the current and preceding period, not an operating segment in the current period, but in the preceding period. That is to be taken up as operating period only. Continue that as operating segment during the current year. Not an operating segment in the preceding period, but it had happened to be a current period operating segment. You have got to report separately for that for the previous period also. Restate for comparative purposes for the preceding period unless information is not available on cost to develop would be excessive. This statement will always be on conditional basis. So tomorrow the college will be open subject to, always it will be there, right? What to report? Each operating segment has got to give general information, revenue, result, liabilities, basis of measurement, reconciliation. So these are the items that you expect in the case of operating segment. What are the general items you have in the case of general information? So factors used to identify entities' reportable segments, judgments made by management in applying aggregation criteria, types of products and services which each reportable segment derives revenue. Now, one important thing that you should always be remembering is that whenever you take revenue as a basis, we need to know what is a revenue as a base that you have got to choose. You have two types of revenue. One is external, the other one being internal. What do you mean by internal revenue? So you find a company may be operating in different segments, different sectors. So you find one sector output is going to be an input for another sector. So you do not effect a sale outside to your entity, whereas you effect a sale from one division or one sector to another sector, but within the company. That is what you take it up as internal. The next item is interest revenue. Then you have interest expenditure, depreciation, amortization. Then this is repeated. Entity's interest in profit and loss account on associates and joint venture to be accounted on equity method. We need to do something on consolidation a little elaborately, maybe in class number 7. Explanation on segments. So where we are expected to provide explanation on results, assets and liabilities. So what and all we are expected to disclose, we do have, and let me just tell you about thresholds that we are expected to use. Threshold points. Revenue 10% of the total revenue. Whichever segment is giving you at least 10% of the total revenue. Total revenue means external plus internal together. Based on results. What do you mean by based on results? Results could be profit, it could be loss. So aggregate all segments which are reporting only profits. Aggregate all segments which would be reporting only losses. So in absolute terms, whichever is higher, in absolute terms, whichever is higher, in absolute terms, whichever is higher, take as a base. 10% of that base, if a segment is reporting, then it becomes a reporting segment. Assets of the total assets of the enterprise, 10% of the assets of the enterprise. And when you have this threshold points like this, management has got choice of identifying and classifying a segment as reporting segment, even without satisfying the thresholds. Choice of identifying, classifying a segment as reporting segments is left with the management even without satisfying the thresholds. Aggregate of revenue of reportable segments shall be greater than or equal to 75% of the enterprise revenue. What is that? Aggregate of the revenue of reportable segment should be greater than or equal to of 75% of the enterprise revenue. That means here exclude internal revenues. Okay. Exclude internal revenues. Now, for a moment, I will stop. I will share institute study material for the purpose of solving a problem, and maybe with that the 6th class will get over and we will identify what accounting standards that we are expected to complete and why we need to revisit other accounting standards once again, that we will be discussing towards the end. So now let us just take up that. Very small accounting standard that you have. How you got to make a presentation that they have shown. Yeah. So the entire accounting standard has come to an overall discussion here, overall determination of reportable operating segments based on management reporting system. Do some operating segments meet all aggregation criteria? Yes, would mean aggregate segments if desired. No means do some operating segments meet the threshold would mean yes and no. And no would mean do some remaining operating segments meet majority of the aggregation criteria. No and yes, we do have to identified reportable segments account for 75% of the entity's revenue, excluding internal revenue. If yes, take it up. If no, report additional segments if external revenue of all segment is less than 75%, aggregate remaining segments into all other segments category. Once that is satisfied, then you don't have to do once again to continue with this activity. You can have some of the segments need not be reported at all, need not be classified as reportable operating segment. So I remember that November 23 examination carried one question in 108. Now let us just take up X Limited has identified 4 operating segments for which revenue data is available. One moment. Segment, say X Limited has identified 4 operating segments for which revenue data is given below. Segment A, segment B, segment C, segment D. External revenue 30 lakhs, 6 lakhs, 50, 8 lakh, 50 and 5 lakhs. Internal revenue nil, 4 and 100,000, 49 lakhs. And the total is 36.5, 9.5 and 54. So additional information, segment C is new business segment and management expect this segment to make a significant contribution to external revenue in coming years. Which of these segments would be reportable under the criteria identified in 108? So we understand that 1 crore is the total revenue, external and internal together. So total revenue 100 lakhs. 10% of that is 10 lakhs. So you have segments A, B, C and D. So total revenue of them given there as 36.5, 9.5 and 54. 36.5, 9.5 and 54. So past 10% revenue test, yes. 30 lakhs greater than 10 lakhs. No. 6.5 lakhs less than 10 lakhs. No. 9.5 lakhs less than 10 lakhs. Yes. 54 lakhs greater than 10 lakhs. Next. Management election. MGT election. So they've said that C is going to contribute. No. No. Yes. No. So reportable segments. Yes. On own merit. No. Merit not there. Management election not there. Here it is. Yes. Merit not there. Management elected this. The next one is yes, won't merit. Correct? So that's a way we are identifying. So that's a way we can just do for other cases also. Okay. So now before we could just conclude, let us just know about what accounting standards that you have completed. 1, 7, 10, 12, 16, 20, 21 we are not done, 23 we have done. Then we have done 33, 34, 36, 37, 38, 40, 41, 102, 103, 105, 108, 110, 113, 115 and 116. So therefore 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. So 22 cases we have completed. Right. Now what and all we are not yet done. Done. This is by 6-4. So 2, 8, 19, 24, 28. Then you have 32. Then 107, 109. Either 101, 107, 109. That's it. Then 111, 112. So I would just say 32, 107 and 109. 3 financial instruments. This is with respect to related party and 28, 111, 112 to do with then consolidation. So we are left with inventory. This is with respect to changes in accounting principles, accounting estimates, employees cost, related party, FTA. That's it. So related party and all this, we will do it in the next class, and we will enter into a very big discussion in the next class that is about financial instruments. Okay. Then consolidation. So we will take up class 7 is going to be on 2, 8, 19, 24 and financial instruments. Class 8 will be on to financial instrument and consolidation. Class number 9, we will take up on to 101 and revisit all. 10 also revisit all. Okay. So with that, we will just complete with other topics also, miscellaneous topics that you have, ethics and financial reporting, all that we will be completing at that point of time. Okay. Thank you. Have a nice day. Nice weekend. Thank you. Bye.